In today's episode, we'll be taking a look at whether investors should be worried about tech stock valuations. And so for years, there's been reports that tech stocks have been overvalued, but over the last 6 months or so, there's been a large sell-off. If we look at a subset of those tech companies, Shopify for instance, which was peaking around 1,600 and has since decreased almost 74%. Now this isn't a one-off case. We take a look at Alphabet for instance. There's been a decrease of 20% over the past 6 months. And then finally Adobe, which has decreased over 38%. And so it might be a surprise to some of you out there, but some of these stocks might actually be undervalued. And so the three stocks that I just showed, which was Shopify, Adobe and Alphabet, let's try to understand why these stocks might be considered undervalued. And so first up we have Shopify, which is an e-commerce business. Merchants are able to manage their inventory on the platform starting at just $29 every month. During the pandemic, the valuation increased to all-time highs. Now taking a look at the price to sales ratio, which is calculated by taking the company's market cap and then dividing it by the total sales or revenue over the past 12 months, we can see that it's matching a ratio similar to that between 2017 to 2019. But the difference is that since that date, Shopify has become profitable, and as of 2021 we have a net income of 2.91 billion and a revenue of 4.61 billion. Now it has been mentioned that beyond 2022, the rate of increase won't be as large of that in 2021. Shopify has mentioned that Q4, the metrics will look a lot better in 2022, but the long-term outlook is still solid, and so for investors out there, it could be a great time to buy into the stock when it's more than 70% down from its all-time high. So while Shopify is a rapidly growing company, we have the likes of Adobe, which is already there. Some of the most famous products out there is of course that of Photoshop and their e-signature solutions. So Adobe's management has recognized that the stock is undervalued. In terms of share buybacks, Adobe purchased 3.8 million shares for $2.4 billion US. Most of the time a share buyback will highlight that the stock is undervalued. It has the knock-on effect that it reduces the outstanding shares, and this in turn can help push up the stock price. But as we saw earlier, with a 20% decrease in the last 6 months, if you're looking for a company out there that provides a level of stability, there's also guidance for Q2 of projected sales growth at 13%. And so Adobe could be a stock choice for your portfolio if you're not looking for large fluctuation prices, but still with a level of growth that can push above the 10% each year. And then finally we have Alphabet. That goes without saying that some of the largest brands out there is that of Google and YouTube. We can see in 2021 with a revenue of 257 billion and a net income of 76 billion. We can see just how effective Alphabet is at generating money. So taking a look at their price to earnings ratio with a value of 22, this is the same value that we saw for a brief period back in 2020. But if we compare to other rival companies out there, for instance Apple with a PE of 28 and Microsoft at 30, we can see that Alphabet is significantly undervalued. And so in the past it's been very difficult to find growth companies that are considered undervalued, but with the stock prices that they're currently trading at now, I would argue that investors shouldn't be worried about buying any of the three companies mentioned, and without a doubt other growth-based companies out there could be at a discounted price as well. And so let me know in the comments below if you plan on buying any of these growth-based companies. And so thanks for watching everyone, and with that said, I'll catch you in the next one.